Hi guys, welcome to the first day one of our Learn to Trade Kickstarter challenge. It's great to have you guys here. I'm so excited to get this challenge on with you guys. Now, we're going to really start from the beginning for all those who have never traded before. And I know for those who've traded before, this may feel a little bit boring to you guys, but bear with us so we can get everyone on the same page. It won't take long. We're not going to go into every nut and bolt of the basics of trading. It's just to get you guys kick-started so that we can just move straight on and get into some challenges with our trading. So in this day one session, we're going to look at the basic concepts of the market and charts. We're going to look at the candlestick chart, and we're going to look at just a few basic terminologies. When we've done with that, we're going to give you the link and you're going to download your own demo charting software. Okay, going to kick on now, and hopefully for those who've never traded, you will get something out of this. It's going to be nice and simple so you can understand it quite easily. If you don't understand anything, please go to the Facebook page. Please, everyone, you must connect with us. You must join the Trading Profits Facebook page. You must do that. Submit your answers or any questions you may have on that page, and we can answer them. Let's get together and become a community and grow this page. Invite your friends to join in, and let's go. Right. Some important concepts and terminologies that we're going to look at is about the market movement. Before we do that, we're going to just have a quick look at the market concept in terms of charts and the candlestick chart. So we're going to I'm just going to show you a candlestick right now. For those who've never seen one before, this is what a candlestick looks like. Okay, why is it called a candlestick? It's a Japanese candlestick because it has a wick at both ends. So that thin line there's the wick of the candle, thin line there's the bottom wick of this candle. The candlestick charts are typically made up of two colors, red and green, although you can choose which color, but typically green signifies price going up and red signifies price going down. So we usually see the green candlesticks for the prices moving up and the red candlesticks for the prices moving down. Now, the candlestick that is going up, usually what we call the open, starts at the bottom and it closes at the top. That's the candlestick that's moving up. When the buyers are going up, you'll see this green candlestick. It will start at the bottom and close at the top. The red candlestick starts at the top and closes at the bottom. So we've got the open that we call the start, and we've got the close that we call the finish of the candle. The candles are generally made up in time frames. So if you have a 5-minute time frame, then this candle will last for 5 minutes and then a new candle will be formed. So if you've got a 30-minute candle, the candle will last for 30 minutes. Price will be going up and down within that 30 minutes. You'll see this shape candle. And then when that 30 minutes is complete, you will see another 30-minute candle. Likewise, with a 1-minute time frame, you'll see 1-minute candles. And this range here from the top there to the bottom is the distance and prices that price moved during this time frame period. Okay, the thick colored bit is called the body of the candle. So we've got here the candle body, and the bit that's not the body is called the candle wick. Okay, Right, so that's a typical candlestick bar. There are many different types of charts, and the most common chart is the candlestick chart. Yeah, and as I said, we have segments in that: 1 minute, 5 minute. We even have seconds. We have days, weeks, even a year. Yeah. So these charts are made up of many bars, and the smaller the time frame, the more bars you will see. Okay, guys. When you open your demo and you look at your chart for the first time, you will see something like this. Now, these are the two colored candles we've just talked about. The red one, as you can see, the market is moving down. As the market moves up, we see the green ones. The market moves down, we see the red, moves back up again. Now let's get back to what we were saying just here, where the green opens and starts at the bottom and closes at the top, and also vice versa. We'll see the red opening at the top, closing at the bottom. We'll go and look at that on our chart. So the green candle here closed at the top, this one here. A new green candle formed at the bottom, went up and closed at the top. It went higher, and if you look across, you'll see these are the prices on this chart here, and you can just look across to your right and see the various prices as prices moving up. So the price went up, came back down, and we see the anatomy of this candle. So when this candle closed at the top, the red one started at the top and closed at the bottom. Again, started at the top, price moved up, came back down, came down here, moved back up, and closed here at the bottom of this of the body of this red candle. The next red candle opens at the top, it goes up, it comes down, it comes further down to here, back up, and closes here. Again, we have a green one, opens at the bottom, closes at the top. And this is typically our candle forms. This red line, I'll just quickly tell you, it's called a moving average. Don't worry about that for now. We'll get into something like that later on in the challenge. Okay, guys? So let's have a look where we are. So where we are now, we're looking at some important concepts and terminology. When the market moves, it doesn't move. If it goes up, it doesn't just go up vertically. It doesn't do that. And it doesn't just shoot down vertically. The market moves in waves, and we call these waves trends. And so when the market is going up, it will gradually go up, and it will go up in waves. It will go up, then back down a little, then up more, down a little, up more, and create these little waves. Eventually, you can look at it as you see here. We got a wave here. The market comes down, goes up a little, comes down. So that was a downward movement there, and it did it in waves. Going back up here, we had a wave going up there, coming back down, going up, coming down, going up, coming down, going up, coming down, going up, down, up, down. So you can see the market just doesn't go up and down vertically in just a shot. It will go in waves. And that's the way the market works. So guys, this was just a quick Kickstarter to get you guys who've never seen this stuff, never traded before, bang up to speed on how a chart looks, a market chart, and what it does. Back to our concepts and our terminology. So we've seen here that you know, a green candle usually is a candle that's going up, and a red candle's candle going down, as we said before. When a candle is going up, it's going up because there are buyers buying this thing, and it's coming down because there are sellers selling this thing. Well, buyers are what we call bidders, and sellers are what we call askers. you won't hear people talk about it in that way, bidders and askers, in terms of, they won't say, are you a seller, and say, are you an asker? They'll just say, have you sold the market? Are you selling the market? But the actual term for doing that activity, that action, is you are taking the asks. Yeah. So when you're buying the bid. And that's how the terminology works. So you can buy the bid price or you can sell the ask price. The other thing we have, the other terminology, and there are many terminologies, but I'm giving you only a few basic ones today. That's all you'll need for right now. So we have the market price. The market price is the current price that the market is at. The current price, the last traded price, is the market price, and it's also the current price. The available price is a little different from the current price. So we won't go into available price because we haven't got time for that, but the market price is the current price. With online trading, it's really cool. If you trade in the forex markets or futures markets, it's really cool because you can sell without first buying. So you don't have to buy something before you can sell it. That's the great stuff about online trading. You can just sell it from the off. But if you sell from the off, you have to buy at the end. So a seller becomes a buyer and a buyer becomes a seller at the end of the transaction. Okay? Leverage is what we use to allow us to buy a product that we can't afford to buy with the whole of our money. So if a product costs 100,000, typically a locked unit of, say, a forex product, like forex is a currency, so forex donates the term currency. So you would have many different currencies: the GB pound, the US dollar, Swiss franc, and these are currencies, but when we trade in it, it's usually referred to as forex, the forex market. So these products at a one contract lot could cost 100,000. That could be its value, but you don't need to have that in your account to be able to trade it. So the leverage that they give you allows you to trade with much smaller amounts of money. So when you come across that term leverage, that's what it means, that you're allowed to trade something with less money than is needed. The word instrument is usually used instead of the word product. Someone may say to you, what instrument are you trading? Instead of using the word, what product are you trading? Okay? Now guys, that's all we got time for in this video. I'm now going to ask you to download your demo software for your charting so that tomorrow we can dive straight into the software. You'll see this in the email. So now you've watched the video, I need you to join the Facebook group, post your answers, post any questions, post the answers to the questions asked, and post any question that you need answering. Okay guys? See you soon. See you in the Facebook page.